following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there had a fun and exciting and hopefully profitable trading week and a fun weekend to boot. My name is Mark Longo, and I will be your host for this rollicking romp through the world of options, and I am joined, as always, by my partner in crime, Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, and how was your trading week?
Everything great, Mark. Thanks very much. Pleasure to be here. We had a really lively show last week that I hope the listeners had a chance to hear. We had Mark Sebastian as a guest, and I've gotten several comments that listeners enjoyed his participation. That was a really lengthy show that ran about an hour or so, and I hope that everyone found some of the discussion lively and interesting.
I would anticipate going forward that as we get into some of these meatier topics and conversations, that the show will range well north of half an hour, and I'm sure a lot of our listeners don't mind that because they're tuning in for some meaty conversations on volatility. And speaking of good old Mark Sebastian, the greasy meatball himself, he will be joining us via remote later in the show to do some discussions of what's going on right now in the world of volatility. And with that, we will roll right into the Volatility Week in Review.
It's time for the Volatility Review.
And welcome to the Volatility Week in Review. This is, as the title suggests, where we look back on the volatility trading activity for the past week. And right now we are being joined via remote by the greasy meatball himself, Mark Sebastian from OptionPit.com, our Volatility Views roving volatility reporter. Mark, what are you seeing out there in volatility land, and what did you see over the past week?
This is Mark Sebastian, the Volatility Voice Reporter, and let's talk about our week in review. Well, to say that it was a slow volatility week and a low volatility week might be the understatement of the century. That's kind of like saying that I'm slightly excitable, or Mark Longo has a slightly deep voice. It was a crazy slow week. In fact, right now, 10-day realized volatility, or historical volatility, is near one-year lows. And in fact, if we look back, we're sitting near two-year lows. Every time we've gotten down here, we closed the week with 10-day realized vol at about 6.2%, 20-day at 12 and 3/4, and 30-day at about 14.5. Just really ridiculously low levels. Although I would point out that the 10-day is way ahead of the 20-day right now. Mostly because the 20-day still has March 16th, 15th, 14th. This is kind of, I don't know if this is the eye of the hurricane or this is the calm after the storm. So it's really interesting, but realized vol really low, and then kind of not shockingly, implied vol also really low. Although interestingly, we actually ended up on the week in implied volatility, at least in the S&P 500. Some of the other things, oil, no. A few of the other things, no. But underlying vol of the S&P 500 was actually ticking up, and that's because of the kind of the quasi sell-off, if you want to call that, where we sold off 5 points on Friday. The implied volatility actually popped. The VIX, which is a measure of forward volatility, was, or attempts to be, but kind of isn't, closed at about 787, which it was up 3/4 of a point. If you account for weekend decay, it's more like 1.5 points. What does that say going forward? Well, I think everybody's kind of known that the market's not completely trusting this vol level. Despite the completely low realized vol that we've had, implied vol has not gotten anywhere close to as low as it got in the middle of February. So that is what happened this last week in volatility.
Thank you for that, Mark. And now with that, we'll close out the volatility review and roll right into the strategy session.
The strategy session.
Welcome to the strategy session. This is the segment of the show where we discuss one or two or sometimes more interesting strategies and educational topics from the world of volatility. And we're going to kick things off today with a little bit of a follow-up to what we discussed last week. Our eagle-eared listeners will remember that we dove into the world of variance and volatility swaps last week, and we got deep into the way those contracts are calculated. And of course, listeners will remember that the volatility swaps are indeed the square root of the variance and the variance swaps, and the variance is usually quoted in volatility terms, but it often can be quoted as well in pure variance, which is the square of the volatility. And of course, all that square rooting back and forth can confuse a lot of our listeners. And we touched a little bit on root mean square calculations that go into some of these contracts. And I know, Don, you hit on last show a little bit about, I think, the logical fallacy that some people make, that they can use the root mean square calculation and derive volatility for 1 month, for discrete 1 month periods, and then in their mind just add up these 3 discrete 1 month periods, and somehow that equates to the same level of volatility as the 3 month contract over that same time period. And there are a number of errors in that logic, and I know you're chomping at the bit to dive into them and just continue the discussion we had last week. So why don't we do that? Let's dive into that and discuss some of these issues that people have when using the root mean square to derive volatility over discrete periods.
Yes, surely. The fundamental principle is that variances, again, the square of standard deviation and therefore the square of volatility, variances can be averaged in a linear fashion. So if I say to you, here are 3 consecutive 1 month variances, 100, 200, and 300. We can add those up, getting 600. We can divide by 3, just a plain old average or mean, and get 600 divided by 3, 200, and say that the mean or average variance for that entire 3-month period was 200. Now, the minute that we go to volatilities and we take a look at 3 consecutive discrete volatilities, and here I'll use more realistic numbers, so let's say 10, 20, and 30, you have to be careful not to do a simple linear average because it's simply not the correct way to do it. So if I were to naively look at 10, 20, and 30, these are now volatilities, and think that I could add them up and get 60, and then divide by 3 and say the average volatility for that 3-month period was 20, I'd be making a mistake. And so what needs to be done instead is what is called the root for square root, mean, taking the average, root mean square, you square the results and then take the average, and we'll get to it in a minute, calculation. So let's take those same 3 volatilities, consecutive 1 month values, 10, 20, and 30, and see how you actually need to do it to come out with the overall volatility for the 3-month period. And listeners, if you've got a calculator nearby, or I'll give you a couple of seconds to run and grab one, you might even want to follow along so that you can see how the calculation develops. Okay, hope you grabbed your calculators. So now we've got 10, 20, and 30, and we're looking for the volatility for the 3 months. Here's what you do. First, you square the 10. That gives you 100. Then you square the 20. That gives you 400. Then you square the 30. That gives you 900. And you add those three values. 100 plus 400 plus 900 is 1,400. Now you take the mean, or the average, of those three squared values, so 1,400 divided by 3, and we make an assumption here that the 3 periods are equal in length. If they were a different number of days, we'd have to actually multiply each value by the number of days in the period and then divide by the overall number of days and get a weighted average. But I'm trying to keep it simple, so we make believe that all 3 of the volatility values represent equal number of days in 3 consecutive months. So 1,400 divided by 3 gives you 466.67, a little bit of a decimal there. And now I finally take the square root at the end of all of that. And the answer, not surprisingly, turns out to be 21.60. Now, it's not exactly 20, but it's close to it. So listeners may think, well, you know, I'm in the ballpark. You said it wasn't going to come to exactly 20, but I'm not terribly disturbed that it comes to 21 and a fraction. At least it's a down and dirty, close way if I would have just taken average. Well, no, you can't do that because not all 3-month periods turn out to be orderly like 10, 20, and 30. So let's take one more example to clinch the idea and to see how sometimes you can be really far off if you apply a simple and incorrect linear type of averaging. Suppose the 3 periods were now 10, and then 10 again, and then 40. Something happened, a big event, the market got roiled a little bit, 3rd month had a 40 volatility. Those 3 numbers, if you did a naive average, would still add to 60, 10, 10, and 40. I could still divide by 3 doing it the wrong way and come up with 20 and think that that would be the volatility for the period. But let's do this root mean square again and see what happens this time. The first 10 squared is 100. The second 10 squared is 100. We're up to 200. And that third 40 squared gives me a huge number of 1,600, which when added to the previous values, 200 more, is 1,800. Now I divide by 3, that's 600, and this time the square root of 600 is 24.5, 24 and a half. Well, that's significantly different from that linear 20 that I might have supposed was the way to do it. 24 and a half is 22 to 23% higher than the 20, and I'd be making quite a mistake. So what's the takeaway from all of this? If you're looking to hedge volatility exposure over a longer period of time, for example, a 3-month window, maybe you're an options market maker. Maybe you're an options spread trader. You want to lay off some of the volatility exposure from 3-month duration options. We have our volatility contracts, or our vol contracts, and they come in different flavors. So we have the 1 vol, which is 1 month duration, and we have the 3 vol, which is 3 months duration. So if you're in it for a longer term or an intermediate term, let's say of 3 months, you would be better served to capture the actual 3-month volatility by using the 3-month product than you would if you strung together consecutively 3 1-month volatility contracts for the very reason that we've just discussed. If you do April, then you do May, then you do June, and you hope to come away with the 3-month volatility of the April 1st to June 30th period, you might find that you're disappointed, or you might find that you're surprised at the end because the 3 consecutive 1 months are not necessarily a good surrogate for the 1 3-month. So it's something that I would like to point out to the listeners, and I hope that they have followed the examples.
Now, Don, it's interesting the way you described that, because in many ways it is the opposite of what we teach for options traders when they're first coming into this market. And the math is different and the scenarios are not identical, but there is a similar logical fallacy with this. We see people coming into the options market quite a bit looking to generate income through covered calls and other strategies like that. And we see quite a few on the Options Insider. We get this question all the time. We see people coming in and they'll say, well, you know, I could write a number of consecutive 1-month calls and collect X, or I can just write this one leap for a year and over the same period and just make it easier for myself, and look at how much money I'm collecting by writing this leap. And so they end up writing the leap, and then they think that is the same thing as if they had rolled calls every month, when in actuality, when you're writing covered calls, it's actually the opposite. It's preferable to write each individual call and roll them every month and collect that high period of time decay that occurs at the end of each option's lifespan, as opposed to writing the one option, and you will actually collect far more decay, and also in many senses you will generate a more accurate measure of what the overall income you could generate and the overall decay you could collect by doing the 1-month contracts as opposed to the net contract. So in many ways it's the opposite of what you would do with the volatility contracts, where the 3-month calculation is actually more accurate than doing consecutive 1-month discrete contracts. And I know I'm sure a lot of our listeners were thinking of something similar to that, because that is indeed what many of our listeners write to us on a regular basis to discuss different ways that they could generate income. And that is interesting to see how in the volatility world it is indeed the opposite of that. I'm sure you did a lot of that, those sort of calculations when you were on the trading desk of where the primary way to generate income is versus a long-term option versus collecting near-term decay.
Right, and that has to do exactly with what you said. It's the profile, if you will, of the curve of the time premium decay of options, particularly near the money options. So options don't decay in linear fashion if they are close to at the money. They decay slowly at the beginning, and then almost as if it's falling off of the table, they decay much more rapidly towards the end of the expiration. And indeed, that itself is also a square root function, which simply means that if you have half of the time remaining to the expiration, the option actually has retained the square root of a half, or about 71% of its time premium. It hasn't lost 1/2 of it. And it's only until you get to with only a quarter of the time remaining in the life of the option, let's say that it's 4 weeks or 28 days, when you get to that 7-day left level and there's only 1/4 of the time remaining, well, it's only then that the square root of a quarter is 0.5 or a half, that the option has lost half of its value, and you realize that it took 21 days for it to lose half of its value, and now it's going to lose the other half in only the 7 days that are remaining. So again, you have this square root function, and therefore people who write calls consecutively from 1 month to the other benefit from this rapid decay towards the end of the life of the option, as opposed to doing it once for a 1-year period, where obviously you have to wait a long time to get that steeper part of the decay curve.
Exactly, to get to the juicy portion of the options decay. And of course that is, it is interesting how you can always apply logic and apply knowledge from one area of options trading to another. And of course, we've discussed ourselves on that a little bit on the show last week, I believe, in terms of discussing volatility as being cheap or low-level volatility and some of the interesting pitfalls that can become associated with that. And of course, we only had a chance to really touch on it a little bit, and I know some of our listeners have written in on the forums to ask our own points of view on this topic as well. So this might be an interesting time to get into a little bit of a meatier discussion on, of course, volatility and describing vol as being cheap. And I know, Don, you have some very deeply held beliefs in this regard. So why don't we start off with discussing some of the pitfalls of that, and then we can get into our own personal viewpoints on what we think in terms of buying cheap vol, or even the concept of buying volatility in general, because I know you also have some deeply held beliefs in that regard as well.
Well, that's true. And in all fairness, I would point out to the listeners in all humility that, yes, I do have strong feelings about the topic, but that doesn't mean that there aren't other points of view, and I surely respect those. So I've had some lively discussions over the years and in my options seminars and lecturing. Again, all points of view are welcome. We welcome listeners' questions, and the fact that I may feel strongly about selling time premium and selling options surely doesn't mean that there aren't other points of view. Of course, as I also sometimes point out, the fact that you disagree with me doesn't necessarily mean that I'm wrong. But in any case, I certainly respect everybody's point of view, and I can always learn a little bit more by listening to other viewpoints.
What's the old saying? You can always tell a genius because he thinks precisely the way you do.
There you go. So let's talk a little bit about this whole concept of value and implied volatility and realized. And I sometimes like to set it up and make an analogy to options by talking a little bit about the insurance world and buying life insurance or any kind of insurance. So you have an insurance company and they hire the best actuaries to look at groups of people and mortality rates and try to figure out on the average how long a person in a particular class of individuals might live and what the lifespan would be. And then they try to figure out a premium for a life insurance policy so that if you paid that premium every month, there would be some probability as to the value of the aggregate premiums that you would pay with respect to what the value or the premium of your life insurance contract was. And so the first question that I always ask people to whom I'm speaking or lecturing is, how do you suppose the insurance company figures those premiums? Do you think that they get all the math and the life expectancies and then make the premium such that they just break even in the aggregate? Everything comes out a wash and there's no profit potential whatsoever for the insurance company? Most people kind of laugh and smile and say, look at all those big, beautiful buildings that the insurance companies build. Of course not. They build in a markup. They build in a profit such that the premium that the policyholder pays is not at all a correct reflection of the probability that he will live just long enough so that his beneficiaries collect an amount that would be equal to the premiums that he paid in the aggregate. Now, of course, we know that there are all sorts of extremes in individual examples. You can buy a policy and die tomorrow. Well, too bad for you, but also too bad for the life insurance company because they haven't collected any premiums at all, and now they've paid out this big lump sum. Of course, you can live a very long and healthy life and be paying all the way through and pay in a great deal more than you actually collect or your beneficiaries do when you die. But the fundamental principle here is that it's not, if you will, a fair game. You could also make the analogy to casino games where there's a built-in house edge at each one of the games so that in the long run, they come out the winners. Can there be short-term winners from the patrons? Well, yes, of course. People get lucky. But long-term, you can't make a living shooting dice or playing roulette simply because the house advantage eventually grinds you down. So, with that in mind, let's turn to options. And let's take a look at this concept of implied volatility. when someone sells an option, and let's take the at-the-monies for the time being, that person has somewhat of an open-ended risk. That is to say, you can sell an option for $2 and it can go to $102, but it can't go anywhere below zero. So you have an asymmetrical payoff where the seller assumes that open-ended risk and where the buyer, on the other hand, can't lose any more than the premium that he has paid. And all of our listeners understand that. Well, because of that open-ended risk, the sellers command a markup. They command a premium from the buyer, just as our insurance company did. And so they price options according to the Black-Scholes model with an input for volatility that is traditionally and in the long run somewhat higher than the actual volatility that the underlying asset goes on to display during the period that you're holding the option. And long term, at least for equity, and people are familiar with VIX and with the S&P 500, long term, over as long as options have been in existence, that risk premium has averaged approximately 4 to 5% in volatility points. So if long-term historical or realized volatility for the S&P 500 is in the 16 to 18% range, then you often see, and people are familiar with VIX and the VIX cash, an average value of about 4 or 5 points higher. So let's call it the 20% range. So now what does that mean when you talk about, gee, I'm a student of VIX and it's usually 20% and now I see it down at 16. Wow, that's cheap. That's at the low end of the spectrum. I can buy options for 16% volatility. Cheap volatility. That's wonderful. Well, the problem is that that's the average volatility of the S&P 500 over a tremendously long period of time. So if you go in and you buy the 16 expecting that you're going to make out like a bandit, but it turns out that the S&P goes on to display what historically is its normal volatility anyway of about 16, you haven't made anything at all. You've bought 16 implied volatility. The underlying has gone on to display 16 realized or actual volatility. And if you've been hedging every night in a delta neutral straddle, for example, you wind up more or less even. So I've always got somewhat of a pet peeve when people talk about, gee, look at this cheap volatility. It may be cheap from the spectrum or from the aspect of implied volatility range, but that doesn't automatically mean that it's a license to steal when you buy at those levels, because there is this built-in risk premium. And of course it moves around. Sometimes we even get implieds crossing with realized volatility. Sometimes the spread is 6, 7, or even 8 points. It's not as if it's a static number, but on average, it's about 4. And every time you buy an option, you have to consider that you're like a salmon swimming upstream, and you've got to fight this risk premium that is built in, that the sellers command from the buyers.
Now, it's interesting. I think a lot of our listeners, at least some of the savvier ones, realize that, these market makers, when they're trading with them, they will have a theoretical value and a theoretical volatility level that they will gear their pricing off of. And so it makes sense that they would want to command a higher volatility level to sell that option than they believe that it is worth. And I think most of our sophisticated audience will expect that when they go into trade options.
Well, the next problem kind of relates to that in more of a theoretical way, and perhaps you'll have a comment on this as well. It then leads to, I don't know if you want to call it exploding a myth, or at least let's discuss it a little bit. You hear over and over again And you hear it from some very intelligent people. So this is a widespread type of comment that you hear. And that is, namely, that implied volatility, whether it's in the VIX or whether it's through backing it out of options pricing models, that somehow or other implied volatility is supposed to be a prediction of future actual volatility or realized volatility. And this always rankles me when I hear it, because if that were the case, then they're doing a pretty lousy job of predicting. Because if you take a look at these implieds and you take a look at what realized goes on to be 30 days later, 60 days later, whatever, you've got this gap, this historical 4 or 5% differential. And so obviously, if someone were truly trying to predict, such as Robert Engel with his Garch models at the Volatility Institute, whom we have partnered with to provide forecast volatilities on our website. And Engel, as you know, received the Nobel Prize for his pioneering work. If you were truly trying to predict what future realized volatility would be, then why would you build in a 4 to 5% premium above that value? Just doesn't make any sense at all. So what people miss sometimes is that giving it any credit at all, what we need to say is that implied volatility is at the very best, giving it the benefit of the doubt, a biased estimator of future volatility, which means that we certainly can't just take the implied volatility number and say that's our best guess for future realized volatility. We know that that's wrong going in. But of course, if implied volatility is 40%, we might come away with the notion that, gee, the next month's going to be, pretty volatile, because it's a biased estimator. It's in the ballpark. It doesn't do a bad job, but you can't just look at the number and call it a surrogate for future realized volatility. It simply isn't that, and it doesn't pretend to be. It's just that people often express it that way, and it's somewhat of a pet peeve of mine because it just isn't the case.
I think we could fill an entire show with your pet peeves, Don. But I think anyone who just has to look at the VIX and then look at the realized vol on the S&P 500, and they could, I think, usually see just how poor of a realized vol predictor the VIX actually is, and then they could jump to their own conclusions from there. I do want to take one quick second just to clarify something, because I know some of our listeners may think, that when you say that, the sellers are commanding premiums and that, that the house has all these odds in their favor, that we're somehow denigrating the old market makers or perpetuating that myth that, market makers are out there to squeeze the customers. And, as a former market maker myself, I like to always correct those misconceptions. I think the mass exodus of market makers from the options market in recent years shows that the odds of the house are rapidly declining. And, we're not saying that market makers are out here squeezing individual traders or anything along those lines. It's just that they price in a higher volatility level as to be expected whenever they're selling options. I think
absolutely, and I perfectly agree with that. Market making is a profession, and when you are professional and you're engaged in an activity, you are entitled to make a profit. Otherwise, what's the whole point? And so the built-in edge or the profitability of having implied volatility somewhat higher than realized surely is the case. And of course, market makers need to make two-sided markets. And so they aren't always selling, and therefore it can cut both ways. So I perfectly well agree with you, and that's understood.
Since we are talking about premium levels and about buying versus selling volatility, it might be a good time to, I think, address that question that came up in the forum that I know you posted a nice lengthy response to, but I'm sure a lot of our listeners haven't had a chance to read it. And we did have a listener, and usually we would do this in a separate segment, but it ties so well into what we're talking about right now. We had a listener and post in the forum, goes by the name Options Guy. We've seen him around the forum quite a bit. And he wants to know about our opinions on buying versus selling volatility. He wants to know, are Mark and Don more volatility sellers or volatility buyers? Generally speaking, I know a lot of, quote, old school options guys. And he wrote this, Don, I did not call you old school. And did nothing but sell vol.
That's all right. I'm old school.
I suspect Don falls into that category. And guys who came into the business over the past decade or two, like Mark, tend to have a more nuanced approach to volatility. And thank you for calling me nuanced, sir. They lean towards selling vol, but they will buy vol on occasion for hedging purposes or if they spot a low volatility level. Now, Don, I know you already posted your response to this in the forum, but why don't you recap what you said and kind of give our listeners a little bit of insight into your viewpoint, and obviously that you're a fan of either selling or not selling volatility.
Well, I guess what my response was simply that yes, in my days on a trading desk, I kind of assessed early on this concept of the risk premium, which was only heightened after the crash of 87 and where the skew was born, so that below the market options, puts and calls with strikes lower than the current market level were showing pronounced, progressively higher implied volatilities as you got away from the current levels. And so it seemed clear to me, if you will, that as a long-run venture, I would prefer to be a seller of time premium and a seller of volatility as opposed to a buyer. And I started to fashion types of spreads that would profit from time premium decay and from this built-in risk premium bias that I assessed, almost as if I was saying, I'd rather be the insurance company than the policyholder. I'd rather be the casino rather than the player. And so what I did was embark upon a type of strategy that was mostly the seller of straddles and strangles. And I jokingly said, as you pointed out a moment ago, that there were times when premiums became extremely low, but for reasons that I just explained, that didn't mean that I automatically was enamored of buying. So those were the times that I'd sit on the sidelines. I was a proprietary trader. I could do more or less what I wanted. And so my motto was sort of, you ought to, with options, do one of two things, either sell them or don't sell them. And so I rarely was a buyer of time premium, and it served me well for the 10 or so years that I was on the trading desk.
I think you should have that engraved on a plaque and hang that over your desk, Don. That would be a fun little mantra to hang over your desk. You know, I do tend to have a similar opinion. I think most professional and former professional options traders lean on the premium selling side of the equation. It's, you know, just from all the training we receive and all the probability lessons we receive in these various outcomes, it's hard to be a professional options trader who exclusively or primarily buys premium. It's a difficult way to make a living. And I know, like I said, when I first walked onto the floor of the CBOE, and there were a lot of the, like Options Guy quoted in his post, the old school traders had the when in doubt, palms out philosophy. In fact, I've talked to quite a few people who used to trade for some of the, large traders that were prevalent on this floor of the CBOE back in the early 80s to mid-late 80s. And they would essentially, if they came back to their risk manager at the end of the day, and they had any long positions on any strike, if they weren't short hundreds, if not thousands of contracts on each strike, they were reamed out and quite often fired. There was just no reason to come back to the desk at the end of the day with long positions on any strike. And obviously, you know, in the years since and after 87, and we've discovered skew, and we do take a little bit more of a nuanced approach to risk management. I think if you went back to a risk manager in today's environment, and had extreme short positions, particularly on the wings. I think most risk managers these days won't allow you to have substantial shorts, plus or minus a few standard deviations away from the at-the-money. They view that as you're essentially, they're selling the lottery tickets, and that's how you blow out. And so
And I agree with you, Mark. I absolutely agree with you. Times change. You have to adapt to them. When the 87 crash came along, it was the first crash since 1929. That's a hefty period. You went 58 years before you saw that kind of a meltdown. And then we had 2008. And, there was still a long period. And, of course, there were other incidents before that. And people started to get nervous. And they would take a look at the risk-reward profile and say, it's wonderful to collect these premiums on somewhat of a regular basis. But then inevitably along comes the unexpected event and something blows up in your face and you give back a tremendous portion of what you've collected, perhaps even over years, if not give back even more or blow out, as you've said. So I don't pretend that selling volatility or selling time premium is for the faint of heart, and you surely need to have deep pockets so that people who are doing this on a smaller level or with a limited bankroll need to understand those risks and those potential pitfalls. And the way I used to say it in my conferences all the time was that, if you built a nest egg and you built up a war chest and then some unavoidable and catastrophic event came along, you might have been able to weather the period. But if your first day on the desk of selling volatility was the week before the October 87 crash, you didn't get to have a second day.
Exactly.
And therefore, I understand that we have to be responsible about this.
Yeah, it definitely is, like you mentioned. It is. I think a lot of people come to options and they think, oh, well, writing premium, this is a quick way to make a buck. It's an easy way to make a living, and it definitely is. You have to have a strong stomach to make that your primary method of income. I used to joke on the floor around expiration, I could always tell who the hardcore short premium guys were just by walking around the floor, because they were the guys who were sweating profusely and they were popping tums and they were miserable right up until the bell rang. And of course, if it all worked out their way and the underlying didn't move that far from the strike, they had a decent month. But it was painful leading up to that, especially at the point where you're making some significant short gamma hedges right up going into expiration. That could be painful. So
it's a completely different mindset, a totally different way from the buyers of straddles and what have you. And it's a very different philosophy, and it surely isn't for everyone.
No, definitely. And of course, my own personal philosophy, like I said, I do lean towards a premium selling. When in my own personal and active trading, I do primarily do a lot of credit spreads and selling premium through time spreads and that sort of thing. And when if I'm looking at an underlying position, I'll never work a limit. I'll always work short puts to do it that way. So I do lean towards the short premium. That doesn't mean I'm not averse to buying the occasional contract, whether it's through a spread or whether it's through, I am a fan of, instead of using underlying positions, I love the occasional bullish risk reversal. A big fan of those types of trades. So there are occasions when I will incorporate a long position, but it's very rare that I will go out and just simply load up on premium for premium's sake. It is usually like you like to say, it is usually a loser's game in the end run.
I forgive you, Mark.
Well, thank you. Thank you, Father Don. I think I may have bought some contracts last week, so you may have to give me some penance for that. Maybe write out I'll have to do some volatility calculations or something along those lines.
Hey, let's face it, people buy lottery tickets. I have to admit that I'm not one of them, as listeners may have guessed. But when these people hit the jackpot, you sometimes are envious and say, I wish that were me standing there. And obviously there's a time when your ship comes in and owning options can be extremely profitable. It's just, as you say, a difficult way to make a living on an ongoing basis for long periods of time.
Exactly. And nor do we counsel that our listeners go out and load up on those lottery ticket options. That's one of our more popular webinars we do is called the top 5 mistakes of options traders. And one of those, I forgot where it falls in our rankings. I believe it's number 2 or number 3, but it is new options traders coming to the market. And for whatever reason, they can't afford ATM premium, or they just want to load up and really swing for the fences. They migrate to the 10 and 20 delta options or sometimes less. And they, like you said, load up and swing for the fences on 20, 50, 100 of these nickel options that are worthless for a reason, and they end up blowing out, or they end up losing all their money and on that trade, and they become disenfranchised with options and don't come back. And so we do whatever we can to dissuade newcomers to the options market from taking that strategy, because it is, by definition, a very low probability type of approach. But Don, I know you and I could probably go back and forth about selling versus buying premium for quite a while, but I think that's going to do it for this strategy session. And with that, we're going to roll right into the crystal ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball segment. This is the section of the show where we discuss what's on our horizons and what we're looking at and what we may expect in terms of volatility for the coming trading sessions. And we are joined once again by our roving volatility reporter, good old Mark Sebastian, the greasy meatball himself. And we'll see what he's looking at for the coming week in terms of volatility and trading and skew.
It's Mark Sebastian, back, your roving volatility reporter, and let's talk about what's coming up the week ahead. Well, the good news is that we figured out that the government can actually get a budget together. They signed it, and it looks like, things are not going to kind of come to a head that the market was a little bit worried about. That could definitely put a damper on any volatility this coming week. But that said, if oil keeps rallying, or if we get more inclinations that interest rates are going to start to rise, I would not be shocked if we started to see some increases in realized volatility. Last week we saw good news not rally the market. I know this is going to sound weird, but when a bunch of good news doesn't rally the market, that, to me, is usually a warning sign that and I'm not saying a sell-off, but that's a warning sign that the market is kind of, its expectations have been raised. So if we get something that misses, that could be a real problem. And we have, not a ton of data, but a good amount of data coming. Things that I'm going to be watching for are retail sales on the 13th. Beige book could be interesting on the 13th in the afternoon. That's always one. Michigan sentiment on tax day, maybe. PPI and CPI actually are starting to be things people are going to be paying attention to. When we get into this kind of rate-raising mode where people are worried about rates being increased, that CPI and PPI start to matter. So going ahead, looking forward, do I think that realized volatility is going to stay the 10-day under 7%? No. Do I think the 20-day could stay around 12, 13%? Yeah. But in order for that to happen, we're going to have to see an uptick in volatility. So I do think we get a nice uptick in realized volatility, and I think that's going to be interesting. One interesting thing that's coming up this week that I think will be of note is on the 12th, the GVZ, which is the CBOE's Gold Volatility Index, begins trading options. Now, do I think they're going to be gangbuster? No, but I think they're going to be something to watch. I would be shocked if those options didn't get some play. There's a lot of gold investors, a lot of GLD traders. It might make sense for them to use those GVZ options. So I think that we could definitely see GVZ options have some interesting play. That's something I'll be watching this week. Aside from that, things in Europe, Libya, I think oil. I'll be interested to see when that oil and the markets start diverging. Right now, as oil's been rallying, the market's been rallying. If we see a divergence, that's going to be bad for the market, which would increase implied volatility and maybe some realized volatility. So with that, that's kind of the week ahead report. All right, well, I hope you folks have a great day. I'm Mark Sebastian.
And thank you for that, Mark. And with that, we're going to close out this Crystal Ball segment and also close out this episode of Volatility Views. I want to thank my partner in crime, Don Schlesinger, for joining me yet again on this program. And Don, what should our listeners be looking forward to on the old Volex website, and how can they get in touch with you if they want to learn more about Volex and vol contracts?
We're really trying to make the website as informative and as educational as possible. So there's hardly a day that goes by when we aren't adding some feature, a new article, some other concept for helping traders and listeners to understand what volatility is all about. So again, that site is simply Volex, VOLX.US. Have a look around, and of course, as always, if you have any questions, please address them to us there at info@volex.us or write to me here at the Options Insider on the Volatility Views forum, and I'll be delighted to try to answer your questions.
Hey, Don, you've been quite the player in the forum these days. I'm always impressed with how quickly you respond to people. So if you do have some quick questions, Don will probably get to it before I do. So Don will be the first responder on there. But please, by all means, post in the forum. And that forum, again, can be found at theoptionsinsider.com/forum. Then scroll on down. We have a lot of active forums in there and active sections of that forum. And one of them is the Volatility Views section. You can post your question in the listener questions section. And we have built up quite a few, and we'll probably get to them in a future show where we will discuss all these different questions we're getting. But in the meantime, Don and I will chime in there and answer questions in there as well. You can also drop us an email at the Options Insider Radio Network voicemail line at 312-544-9356, or you can contact the Volex guys over on Twitter at Volex_info, or you can contact us at the Options Insider at twitter.com/options. Just search for options in Twitter and you'll find us. And I want to thank all of our listeners for making this new show such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.